Hi, everyone, and welcome to the Coinbase Institutional Markets Call. I am your host, Dave Duong, the head of institutional research. I'm filling in for Ben Floyd, who conveniently chose the busiest week in markets to decide not to be in and asked me to fill in. But I'm going to be joined today by George, as well as David Hahn and Sarah from our financing team. George, this has been a crazy start to the week. I would love to kind of just get a sense. Are you getting enough sleep at all? Like what's been happening on your side?
Yeah, it can only get better if the week starts like this, right? I think I've been doing this job for a little bit over 3 years now, and I think there's not been many situations when I saw more volatility than now. I think the only 2 points that would come to mind is FTX November 22, and then probably Luna like May, June, and 22, which were comparable. I don't know what do you think, but yeah, I can't come up with any other comparisons.
Yeah, I think in recent history, I think you're right. And we're definitely going to get into it today. We're going to talk about what's happening in markets, what's driving this. We're going to talk a little bit about the flows, the financing space at the moment. And just for good measure, we will cover a lot of the on-chain developments because this has been a really busy week in terms of on-chain developments. But I think a lot of people haven't been paying attention just because markets have been so busy. But before we begin, please scan the QR code or visit the link in the show notes to see more of our research. Please like and subscribe to this podcast so we will produce more excellent content for you in the future. With that, let's get started. So macro appears to be back with a vengeance. My mea culpa, only a week ago, we actually suggested that the FOMC meeting wasn't as relevant because we were very heavily focused on politics, the regulatory environment in crypto. But all of a sudden, it seems like people are paying a lot of attention to what the Fed's going to do next. A lot of discussion around the Bank of Japan, oil prices, tensions in the Middle East. It seems that we've had a pretty sharp regime change in the crypto space where we went from pretty intrinsic drivers so far this year to very much being affected by what's been happening on the macro side. George, I would love to kind of get you in here. Could you give us a quick rundown? What's been selling off? Probably you can just say everything, but what's been happening and what's driving this?
Yeah, for sure. I mean, I think it's been one of those moments on Monday, so yesterday, where when things are selling off and there's some big shifts in the market where correlations tend to go to one. So as you say, it's been pretty much everything that's been selling off, everything but government bonds. So you had a flight to safety. So I think if you look at the US curve, it's quite interesting. 5 years, 10 years rallied around 50 basis points. 2 years, I think, up to 70 basis points. Rally yesterday on Monday. And it's quite interesting, actually, that the 2-year, 10-year spread, which a lot of people are sort of looking at as an indicator for recessions historically, right? That's been inverted, and it's slowly been de-inverting. So if you look back at July last year, that's been at minus 110 bips. Now it's around minus 10, minus 13 basis points. So that's quite interesting. But looking at crypto specifically, as you say, obviously super turbulent. Bitcoin was down up to 16% at one stage. ETH down 21% yesterday intraday at one stage. Most altcoins down 20 to 30% intraday yesterday. Which, to be fair, markets have made that back since then to a large extent, especially as Sarah mentioned in the majors, so Bitcoin, ETH, Solana. But yeah, I fully agree with what you were saying there, David, earlier, that we seem to be undergoing a certain regime change. We had obviously periods in the past where macro was in the driver's seat, but so far this year, maybe even for most of the rally since last year in September, it's been crypto intrinsic factors, namely the ETFs, I would say. If you look at Bitcoin and ETH, longer tail altcoins, perhaps it's been meme coins that have been dominating the discussions, and then the last couple of months, it's been discussions about inflationary tokenomics and a lot of altcoins. But now it certainly feels that macro is firmly back in the driver's seat, and I agree with the three things I think that have caused that. I think It's number one is fears of a recession or hard landing in the US after the weak NFP print for last week Friday. So we're now actually pricing just over 5 cuts in the US until year end. If you look back to 2 weeks ago, even a week ago, I think we were pricing in around 2 cuts. Turbulence because of the Japanese yen carry trade unwinds, and then obviously the geopolitical tension in the Middle East, which is still not resolved. So that's a TBD what happens the rest of the week.
Yeah, what's really interesting about this too is we've seen spikes in the VIX volatility index before, and like it actually went up to around like 65 intraday before it did moderate, and it came down to I think around like 33, 34. But we haven't seen things like that since A, the pandemic, and B, the global financial crisis. And those were just massive events. In this case, it's kind of odd. Do you think like that like this was triggered by Bank of Japan hiking rates, and suddenly the Nikkei declined by 20%? Obviously, you're right. There was a big carry trade unwind. Like, can you just kind of walk us through like what is the like a rational kind of like causality behind how Bank of Japan move actually triggered this huge move in all the other asset classes?
Yeah, so I think the logic or the explanations that I was reading about here is essentially Japan, which has traditionally been the last couple of decades a very low yield environment, right, and with a lot of savings in the economy, right, it's been quite popular trade, especially the last couple of years with U.S. rates in the front end around 5%, for instance, to do a cross currency swap, right, and then essentially swap your yen for dollars and then start generating some or getting some of that U.S. yield, which is has been a very attractive proposition. And now, obviously, the BOJ has been signaling that they're potentially open to more hikes as well, right? And to be fair, they only hiked to 25 basis points, so it's not all that high, but I think it just spooked people a little bit, given that they have been at zero for such a long time, right? And that's obviously then caused a lot of knee-jerk movements in the FX rates. Yen got a lot stronger, and as you mentioned, there's a lot of leverage positions out there as well. So I think some of that has obviously been coming out. But I think in the end, I don't think it's just that, right? I think it's just a combination of all of these things coming together in the space of just a couple of days. So worries of a hard landing in the US, the carry trade unwinds in Japan, the geopolitical tensions in the Middle East, right? All of these things together obviously created a bit of a toxic mix for the market.
And obviously, this was probably one of the worst days that we've seen. Do you think that that's the end of it, and that we're going to start recovering from here, or do you think we have further to go?
Yeah, I mean, like focusing on crypto, I'm not entirely sure if we're out of the woods yet, right? If you look at the technicals, and I'm just going to look at Bitcoin, we're now below the 50-day, the 100-day, and the 200-day moving averages. 55K should be a strong area of consolidation, but it's probably not as strong as 50K, which we've seen yesterday, I think, because it was clear that as soon as U.S. markets opened, right, there's a lot of demand in those low 50s. Hence, we're now trading at 56K, 56.5K again. But I think macro is probably going to remain in the driver's seats, right? So as listening to another podcast this morning, looking at forward PE ratios for the S&P, which is currently around 21, right? So it's 12-month forward PE ratios, that is. And for instance, Morgan Stanley brought a report saying that their fair value model, assuming soft landing, sees that multiple around 19. So obviously, if you wanted to look at cheap levels, which could support the market, that's maybe a 16 to an 18 multiple. So I think obviously there could be some more to go in equities, and I think crypto, the price action that we will see in crypto will be a function of that, of performance of risk assets more generally in the near term, at least. One thing, David, actually that I've been hearing, and yesterday, obviously, there were some rumors, I think, circulating on Twitter as well about a potential emergency meeting of the Fed, which obviously didn't happen yesterday. And you mentioned, obviously, the spike in the VIX. I mean, we've quite rarely seen such big spikes, right? So I was just curious, what do you think about a potential emergency meeting, and maybe even an intra-meeting cut? Because obviously the next meeting of the Fed is 6 weeks away, right? So how would that work, and what do you think would the implications be? Would that actually help to calm the markets down?
Yeah, that's a great question. It's funny how we've gone from particularly being so concerned about inflation that we thought that the Fed could potentially hike rates to going back to cuts, and now going to 125 basis point cuts plus like maybe even like having an emergency meeting. I think it's really unlikely for the Fed to actually do that. To be honest with you, I think the signaling on that would be too troubling for the Fed to actually consider, because honestly, if they try to have an emergency meeting right now, I think it would send more panic through the markets, and they don't want to do that. So I think they're going to be, comfortable just waiting, or comfortable is not the right word. They're probably just going to sit and wait. I think the bigger question is, will they deliver 25 basis points at the September meeting, or 50 basis points? Obviously, as you mentioned, Mark's expecting 50 basis points, but I'm not so sure. The data itself is kind of oscillating, and this has been a problem that we've had because, I, for one, don't necessarily believe that we will get a recession in the second half of this year or even in early 2025, in part because if markets are right and they're expecting that we're going to get a technical recession, which would be 2 quarters of negative GDP growth, that means we should be actively contracting right now. And just yesterday, we got ISM data on services that suggests that things are actually okay. And I think that it assuaged some of the fears that they could actually, things are quite that bad, and the Fed needs to deliver on this emergency rate cut. So I think that this is kind of what we're going to be getting, like this data dependency, this kind of seesaw pattern. And, yes, some of the labor demand data itself wasn't great, to be honest with you, but I also think it kind of speaks more to the AI transition than anything else. And it's really kind of contingent on how people want to read the situation. But I don't think actually the economy looks quite as bad as some people are forecasting at the moment. So, I think that it's still going to be a question as we approach the September meeting date as to what the Fed is actually going to do here. But I don't even think it's guaranteed that they're going to deliver 50 basis points at the next meeting.
Yeah, it makes perfect sense to me. I agree with you. I think obviously the NFP print was bad, right? But overall, I mean, we had mixed data for probably a couple of quarters now, right? And yeah, I'd be very surprised to see 125 basis points of cuts until the end of the year, as you say, which is being called now by a number of major banks. Because, yeah, it just feels a little bit weird in terms of, in the past when we had so many cuts in such a brief period of time, something objectively much worse was happening to the economy, right?
Yeah, and I think a lot of people were focused on the unemployment rate, as you kind of alluded to, and triggering of the SOM rule, which, yes, I think it's relevant. I don't think it's unimportant because it's a good signal that, hey, maybe something is amiss inside the economy. But I also think that just any single indicator for recession, and we've had the inversion of the yield curve for quite a while. But it's hard to kind of say that even though that we've have 70 years of evidence that it's worked as an indicator, there's nothing that's kind of a hard and fast rule, because it's kind of hard to read these things, and the situation is a little bit different. I would like to kind of bring David Hahn in here, because I think that the impact on crypto markets also isn't fully clear cut, in my opinion, because it seems that crypto over the weekend acted more as a proxy hedge against people's concerns surrounding global recession and how that's going to impact portfolios with equities and other things. David, what other things should we be paying attention to in the crypto markets, and how do you kind of read the impact that it had on prices there?
Yeah, I think that people have been, back on the recession fears that you guys have been talking about, I mean, I think that the market's been reading all these news about like negative recession indicators for the last several months, and then the unemployment print, the NFP print on Friday, was what really spooked the markets out, and they were like, "Hey, maybe I should start listening to these things." So I do think that we're going to kind of be in a sit and wait and just see what the Fed does kind of position, like we were for much of last year. That said, I do think there are some endogenous crypto catalysts that also contribute to the price action. Last week, we had on-chain movements by wallets tagged for Genesis and also for the U.S. government that moved a combined more than $3.5 billion in Bitcoin and ETH. The exact distribution mechanisms are not yet clear. What's exactly happening with those is also not yet clear. But that's definitely overweighing the market or weighing on the market as a potential supply overhang. I think that one thing that is interesting, though, that I do want to call out is potentially some of the regional differences in terms of the trading action. So on Friday, when we had the NFP print, we actually saw Bitcoin drop from 65 down to 61 during US trading hours. But the real pain really occurred on Sunday evening US time, which was Monday morning in Asian markets, where we actually had a sell-off from 59 down to 49 in a matter of a few hours. So I think that this kind of speaks to the fact that there are different constituents buying and selling crypto, and how that relates differently to different components of markets. One thing that might be interesting and might be slightly overlooked is that as the U.S. dollar is kind of weakening against the yen, the price of Bitcoin, price in U.S. dollars, but the purchasing power of Bitcoin relating to yen has actually been dropping, and so Bitcoin's actually been getting more and more expensive or relative to the Japanese yen. So I think that's also something that might be worth noting when it comes to market action in Asia hours versus US hours, and also how they interpret different economic prints.
Yeah, I think that's a really good point, David. And, for anyone who didn't see it, from the research department, we did publish a very short piece just in terms of what has been driving this market over the last 48 hours and what our view is for the remainder of Q3 and Q4. The TLDR is that we still expect that things are going to be choppy in Q3. We don't think that this is the beginning of a new cycle, though, and we are still constructive on Q4. But we got to say, like with the movement that we've been getting in this market, conviction isn't as strong as it used to be. But I still think that for the most part, people should remain positive in Q4, and I don't believe that this sell-off is going to worsen as we get into the next quarter. Moving on, though, I want to bring in our head of prime financing trading now, Sarah Williamson, since I think financing is a big part of what happened over the weekend. Sarah, I mean, just really a general question. What did finance activity actually look like over this weekend? It seems like there's been a lot of concern surrounding margin calls here. What's your take on this?
Yeah, thanks, David. I think the first thing to say, and what we probably got the most inquiries were around, was margin calls. So I would say everything that we saw in the marketplace, because of the market being down so much, there were margin calls kind of across the board as collateral values declined. Those margin calls were met in a timely fashion. I think the financing markets continued to operate in a really orderly way as we expected, and those calls were met on time and on schedule. So that was really good to see. I think it speaks to some of the maturity in the financing markets over the past year or so, but exactly what we would expect when the market is dropping. There would be margin calls, and those would be met by participants. So that was great. And then I think in terms of activity, we did see an increase in client activity across the financing space. And I would say most of the activity we saw was actually clients buying the dip. So borrowing to purchase and take advantage of that, mostly in the majors. We also saw an increase in single coin shorting. So clients utilizing some of our products to actually go short on specific coins. And then we also saw, I think specifically Sunday into Monday morning, an increase in demand for leverage. So clients, mostly active traders, I would say, taking advantage of being able to borrow and lever up a little bit to continue to trade in the market.
So that's interesting. You're actually suggesting that people were putting on long positions here in the last 24 hours, people have been talking about liquidations, and it seems like it's a little bit more balanced between the longs and shorts. But yet the price action is kind of suggesting that there might have been a short squeeze. I mean, how do we make sense of all this?
Yeah, I think George will probably touch on this when he goes through the flows, but there were, during that sort of 24-hour period, there was about 1.2 billion in liquidations in the perp markets. I think more recently in the past 24 hours, we've seen another 400 million in liquidations in perps, but that was pretty equally balanced between shorts and longs. I think it's worth noting that in DeFi, the TVL over the last 2 weeks has decreased pretty substantially. So it's down more than 25% from year-to-date highs. So from around 37 billion to 28 billion. So there's definitely been some leverage that's been coming out of the marketplace over the past couple of weeks and then into sort of the moves we saw this weekend. But it is encouraging to see people continuing to put on shorts when the opportunity is right, as well as being able to borrow and lever up when they need to. I would also mention that the rates to borrow USDC in DeFi markets has come down pretty substantially. So it's at relatively low levels compared to where it's been over the past couple of months, while Bitcoin and ETH have remained pretty stable. So I think there has been some leverage that's come out, as we mentioned, over the past 2 weeks, but most likely, if we continue to see volatility, people will want to take advantage of that.
Interesting. And is there anything that you can kind of compare this to in previous crypto cycles that you think it looks very different about this current market?
Yeah, I would say the last time we saw sort of this much volatility over a short period of time was probably around sort of the FTX bankruptcy time. And the financing markets were in a very different place back then. I think primarily Bitcoin was being used as collateral. There was a lot of unsecured borrowing and lending going on in the marketplace. So as there was that volatility, there was a little more panic in the market as it related to people being able to meet those calls. I think there was recalls in the space as well. And this time around, I think there's been a lot more maturity. There's better risk management in place across the financing counterparties that remain. And as a result, everything was really, I think, orderly is the best way to describe it. It functioned just like we would expect sort of a more mature market to react. So I think we take that as a really positive sign and a good direction of travel.
That's interesting. Do you think that's just because we're in a different, because we've experienced that, we're in a different kind of place now, and leverage overall in the crypto space is a lot more reduced than it used to be?
I think leverage has been reduced. I think the number of providers of financing has been sort of dramatically decreased from what it looked like back in those days. So the fact that people were able to lend unsecured and borrow unsecured meant that there were a lot of counterparties who might not have had the experience going through such volatile markets, or the understanding that those things don't stand up in volatile markets. So I would say that the remaining participants who are financing people seem to be taking better measures. I think looking more towards traditional finance and some of the best practices around lending over collateralized, borrowing with collateral in place, and making sure we're maintaining people's capital. Those are all important, the most important tenets sort of financing businesses. And it seems like that is what is driving sort of the better stability here.
That's great. Thank you so much, Sarah. It's always wonderful to have you. So if you could stick around, we'd love to have you chime in on flows. We're going to talk about that next. But we're going to move on to George. Obviously, we've gotten this big move. Funding rates are kind of all over the place. We've got open interest down. George, I would love to kind of have you come in here and comment a little bit about what you're seeing.
Yeah, for sure. Thanks, David. And I mean, I think Sarah summarized it really well, that obviously while it has been at one stage a pretty aggressive move down, all the activity that we have been seeing from institutional accounts on the trading desk here as well was very orderly. So market overall, as Sarah mentioned, has seen $1.2 billion in perp and futures liquidations. yesterday on Monday, that is. So that's, I believe, the highest number of liquidations that we have seen since April. And as you mentioned, if you look at Bitcoin, for instance, specifically, open interest has come down around $7 billion in the space of the last week, so down by around 30%. But if you look at institutional flow specifically, it was pretty much two-way, I would say, over the last 48 hours and during the heat of the sell-off as well. We have seen a good number of fast money accounts trimming risk as the market was selling off in the first half yesterday of the day. But there have also been funds stepping in to buy. And when I say buy, mostly very similar to what Sarah is saying on the financing side. On the flow desk as well, we've been seeing interest to buy Bitcoin and ETH, and to a lesser extent Solana as well, but definitely very heavy focus on the big coins, which makes sense in an environment like this, where obviously liquidity widens out across, or spreads widen out across the space. Liquidity gets a little bit worse, but even more so over proportionally in the longer or the further out in the tail you go of the risk curve. At the same time, I would say it feels like there's no rush to allocate here, at least from institutions or funds that we spoke to. It's definitely been a great level to start getting some great fills, but there's also a feeling that a lot of folks want to see the dust settle first. And altcoins, as I mentioned, pretty limited interest overall, I would say, which is a bit of a continuation, I think, of the trend that we have been seeing the last couple of months since March or April or so.
What have you been seeing on the ETF side? I think behavior for Bitcoin and ETH ETF flows are maybe slightly divergent, but how do you, well, number one, how do you see them behaving right now? And number two, how do you see them behaving after the sell-off?
I think it's a great question. I mean, I don't really have a good answer. I think it's going to be super interesting to see how they are going to, and what kind of flows we are going to see over the next couple of days, given obviously we have repriced a little bit lower. If you look at the flows, Bitcoin, the Bitcoin ETFs on the net basis have seen about $400 million of outflows over the last 2 days. Which again, as we mentioned earlier, it's correlated to the markets overall, where correlations have been going or approaching 1, everything's selling off. So not a huge surprise. In ETH, actually, after a somewhat, let's say, a lackluster start, I think flows have definitely improved over the last week or so, despite the volatility yesterday, especially flows in aggregate over the last 7 days, plus minus, have been flat, and it's been great to see that actually the outflows from the legacy Grayscale ETH fund have been slowing down a lot. So the latest number for yesterday, I believe, there was around $47 million in outflows just from that one specific fund. So it's been great to see that that's obviously sort of slowly tapering off. And of course, you have to admit that the timing of the launch also affected that, given it was a much more difficult period. But I think it's going to be very interesting to see how the flows evolve, and whether we'll see more buyers step in for these products over the next week or two.
And George, are there any headlines we should be paying attention to? I know, for example, Morgan Stanley had a headline suggesting that now RAs are allowed to recommend some of the Bitcoin ETFs. They should start at some point this week. Also, something about MicroStrategy. I would love to kind of get your views on these things from a demand supply perspective.
Yeah, for sure. I mean, from a demand supply perspective, I think what David Hahn mentioned earlier, that there's been some large on-chain wallet movements from the US government and the Genesis wallet around 3.5 yards. So that's something to watch out for on the supply side. As you mentioned, MicroStrategy obviously announced a raise of $2 billion, which they want to use to buy Bitcoin. So that's on the demand side. FTX, obviously, that's ongoing with people selling their claims, and I think a lot of that money will be flowing back into the market again, especially now that we have significantly more attractive levels. I think one other thing was Tether announcing results as well at a profit for H1 of $5.2 billion, which is huge as well, right? So I think these were probably the main ones outside of, as you mentioned, Morgan Stanley now allowing RIAs to actively pitch the Bitcoin ETF. So at least as a start, the main Bitcoin ETFs, I believe.
That's great. Thank you so much, George. I'll let you go now to get some rest. I'm sure you're pretty exhausted after the market moves in the last few days.
Awesome. Thank you.
David, I would like to kind of discuss what's been happening on the on-chain side. I know like this probably hasn't been what most people are paying attention to, given the macro dominance at the moment, but a lot has happened over the last week. Can you just kind of walk us through some of the things you're looking at?
Yeah, definitely. I mean, I agree that a lot of these things are taking a backseat in terms of price action to the, to the macro moves. But yeah, let's go through some of them. I think the one that's top of mind for me is that Eclipse launched its layer 2 on Ethereum, and Eclipse is a Solana virtual machine rollup. So it's, all the apps that are currently on Solana theoretically could be ported over to Eclipse, and also use ETH as a base currency. It runs on Celestia, so it posts blobs to Celestia. I believe it currently accounts for about half of the blob usage on Celestia as a DA layer. So I think this is very promising. I think this is kind of in line with some of the theses about rollup differentiation, about technology trade-offs, and how rollups can experiment with different types of technology. That said, I think there's a lot of open questions around its adoption and user experience. Obviously, it's just launched to mainnet, but there's still missing a lot of some of the core infrastructure that you might have on Solana. So, for example, some of the large Solana wallets like Phantom and Soulflare are not supported on Eclipse today. It's only Backpack, MetaMask, and some of these other custom RPC endpoints. Other things like Blinks are also not supported on Eclipse today. And so I think there's some catch up to do where you might have a better developer experience on Solana. But I think this is very promising in general. So I think it's a major step forward. And I think I'm very much looking forward to how adoption, both on the user and liquidity metrics and also on the developer side, in terms of how they view Eclipse. I think that's top of mind. But there's a lot of other things too, yeah.
Yeah, I mean, like staying with Eclipse, like it seems that like this was something that was like huge a few months ago, and that we kind of didn't hear much about it until just now. I mean, like, what are you expecting here in terms of apps like launching on or moving from other chains onto Eclipse?
I think we'll definitely see some experimentation here, almost like what we saw with Blast, launching as a Ethereum rollup, and then even though there's Arbitrum and Base, people still build on Blast because this is a unique community vibe. I think we'll see some unique apps that are being launched in Eclipse. Maybe some teams that have not been able to get as much traction on Solana that they wanted to, maybe they'll move over to Eclipse and build from scratch there where they can get more funding, maybe some other ecosystem support. So I think I'm looking forward to seeing some differentiation between the Eclipse community and the Solana community, kind of like how we have differentiation across some of the different EVM-based L2 rollups. I don't know exactly what that's going to look like, but I think that's going to be very interesting to watch develop, because that will have, it'll be an early signal for other L2 rollups. Like Movement XYZ is coming out with a move-based rollup, so that would be in competition to like Sui and Aptos, which are move-based L1s. So I think just kind of watching this as an early signal will be very, very interesting.
And another headline we saw was Avalanche. They apparently have a partnership now with the California DMV. So is this relevant? Like, what do you think? Should we read too much into this?
I think it's interesting. I think it speaks to blockchain's usage as a technology. So Avalanche is helping the California DMV build out a custom subnet. So it's not on the Avalanche C chain. It's not going to be public, but they're using a custom subnet to digitalize driver's license. And I think that's interesting. What's less clear to me, though, is how this will, accrue value to the AVAX token specifically. I think it speaks very strongly to their technology and to their business development team. For full context, the California DMV was actually supposed to be partnered with Tezos in 2023. And then this partnership actually shifted over to Avalanche. I don't know the details or the reasons why, but having previously worked on private blockchains, I'm guessing it has something to do with more control and configuration ability for private subnets compared to just being on a public chain that everyone can kind of view and have visibility, and rollbacks are quite difficult. So I would say that in general is something to be watching. And I think that if we see more of these things, that'd be very promising. But I think it's still a very early stage. Not to discredit it, I do think it's a huge announcement. But I think it's more of a tech play and more of a business development play than like, hey, people are going to start buying Vox tokens to transact on this network.
And along the lines of tons of things happening, we saw a few days ago a Terra hack, I believe, and there was a post that suggested that all the Axelar wrapped assets on Terra are now unbacked. What happened here, David?
Yeah, this one's interesting. So there was a re-entrancy attack that was actually disclosed. This bug was disclosed in April, and then it was reintroduced in a June upgrade. And so a lot of USDC, a lot of Astroport, like Astro tokens, have all been compromised. And so there was a lot of controversies going back and forth. They paused the blockchain, did an emergency patch. So I think this is, obviously Terra is has a lot of flack from last cycle. But I think this really speaks more to just a reminder that security is still really critical and top of mind in crypto. And it should always remain top of mind, especially because a lot of these transactions are not really reversible, right? And speaking of security, actually this morning I just saw there was another news, which was the Ronin bridge. Actually, I know that one also had a history of hacks, also might have been exploited with an MEV exploit. This one looks to be a white hat exploit. So around 4,000 ETH were withdrawn from the bridge and put into Beaver build, which is a known MEV entity on Ethereum. But regardless, I think that as much as we are excited about the technology and the new use cases and adoption, we should never forget about security. And the farther out you go on the risk curve, maybe you have higher returns and more volatility, but you also have the risk of potentially losing quite a big sum if there's a security breach.
And George was kind of talking a little bit about the altcoin side. It seems that Jupiter made an announcement about cutting their token supply. So what do you think here?
Yeah, I think this one's interesting. So the Jupiter team, they created a proposal, and the proposal essentially said, hey, we have a total 10 billion, earmarked supply in general. Let's reduce 30% of that. Like, we don't need that much supply behind. Currently, they have $1.3 billion in circulating supply. So this proposal actually passed the voting. So they're going to reduce the total Jupiter supply from 10 billion to 7 billion, which means that behind there's currently there used to be 8.7 billion tokens that still needed to be unlocked. Now there's 5.7 billions. I think this is kind of promising when it comes to this whole high FTV, low float paradigm. I think Jupiter still has a lot of FTV going behind them, but at least it's reducing this and recognizing hey, this is an issue. And we actually don't need all these tokens to constantly be unlocking, and they're actually taking action, and the community is supporting that. So maybe we'll see more of these things going forward.
And I think last thing is Ethereum, of course, has the Petra upgrade timing, still very uncertain. But there seems to be a lot of contention within the community right now, some debate about the multi-proposer. Could you talk a little bit about that divide right now and what's going on?
Yeah, I think on the Petra side, it feels like this is going to be a huge upgrade, and there's a lot of different stakeholders who want different things in. Some people want, EOF is going to be in. Some people want 7702 in. There's a lot of different standards that are being proposed for Petra, which has been getting some pushback from some of the client developers who are saying hey, there's way too much stuff here. We don't necessarily want to include all these things. Not everything is high priority. So that's kind of been some gridlock there. The multi-proposer thing is something that's been more of a recent, I would say the last 1 or 2 weeks kind of talk that's kind of been getting traction in the community. And the idea behind this is how can we reduce MEV? So that it's always the MEV question again. And so the concept is, instead of having one proposer build a block, and then that proposer can actually just order transactions, the principle is you might have multiple concurrent proposers, so 3, 4, or n number of proposers, and then they all propose a block or a set of transactions, and then these transactions will be sorted in different types of ordering. And so that kind of makes it harder to do run sandwich attacks or front running attacks. There's not going to be a single proposer that can guarantee the order of transactions in a single block. Now, this has been taking off, getting a lot of traction. What's interesting that I think is worth highlighting is that the multi-proposer kind of roadmap has been part of Solana's vision for at least 2 years now. They don't have it live yet, but it's something that's also being talked about in Solana. So I think it's interesting to see kind of these technological solutions kind of converge in some areas at the very least. And so, there's I know there's a lot of debate also between the technical trade-offs between Ethereum and Solana, but it's interesting to see on this point that it's kind of leaning towards Solana's roadmap.
Yeah, I think that's it's interesting to see that there's a lot of things that Ethereum has proposed that Solana has either tried to adopt and kind of front run them a little bit. But I think what's challenging to watch about Pectra is that there's no like overarching theme in the same way we've seen with previous Ethereum upgrades. You know, it's not like the merge, which was very clearly like, okay, let's integrate the Bacon chain, for example, or, you know, like, hey, let's enable withdrawals for validators. There's no like big theme, I think, that's kind of driving Pectra, and it's causing some consternation within the community, at least from the outside. That's kind of what I see. But Dave, thank you so much for giving us a recap of what's been happening. I know there are a lot more headlines out there, but we can't cover everything. And it's just amazing because there's so much stuff happening within the ecosystem, but we can't cover it because there's so much dominance coming from the macro side. But anyway, everyone, thank you so much for tuning in today. Ben Floyd will be back next week, so you'll get a better host. But, that's my time for this week. Thanks for listening. Thanks.